What's going on? Welcome to another episode of the Impel 4 podcast. I'm your host, Leon, and of course, my co-host right here, Rene.
Hey, y'all.
Her hand, she had surgery.
I'm dedicated to the cause. I'm dedicated to be here to help y'all out.
Yeah. We got a good one for y'all today. We got Wealth Management Banker Kylan Patterson Sr. Is that correct? Did I say it right?
Yeah, you said it right.
I said it right. Good.
Mm-hmm.
Yeah. We're gonna have him on, and we're gonna talk a little bit about money.
We're gonna talk money. Kylan and I, we don't work together, but we work for the same company. He's in one of the groups, business resource groups that I'm in, and he recently was a host and talking about generational wealth and how important it is with that we utilize our money and our spending power in certain places that will grow. And I thought it would be great, to have him on the podcast. So many things going on with the boycotts, and I believe every episode we kind of go into general talk about generational wealth and money and investing and all of those things. So to me, it was very important to reach out to Kylan to have him come on the show, because I believe he would provide us with some resources that we can use. And if that chooses you reaching out to Kylan directly and, he can help you out, good for it. That means we did something here at Impel Forward. So I'm excited to have him.
All right. Bring him to the stage right now.
Bring him on.
Hey, good afternoon, everybody.
How you doing?
Man, doing well. Ready to help my people out, ready to share some knowledge and just have a good chat together. So thanks for having me.
Yeah, good to meet you. Now, we was talking a little bit backstage before we came on. Mm-hmm. And Rene, she said she didn't agree with me saying that. I didn't think that one day would do anything. But you agreed with me and said what?
The one day of the boycott. Let's be specific.
Yeah. Of the boycott, yeah.
Yeah, I do agree with Leon that one day of the boycott isn't going to make a significant difference. But that but has a caveat. I think this is a trial run. I think the one day is a way to see, can we organize effectively enough to continue with these actions? As we all know, go back 50 years, the Montgomery bus boycott lasted 2 years. I don't know if we got 2 years in us to, but I think if we can, have data to suggest that this boycott worked yesterday, there are other boycott days that are on the schedule coming up over the next 2 months. And if we can effectively continue those activities, next thing you know, maybe it could be 2 days in a row, maybe 3, maybe 4, maybe a week. And so I think, especially in today's society where people have the attention span of most 3-year-olds, I think it's important to start small with bite-sized pieces and work your way up from there.
Right. I read something where they said actually the boycott, I guess the bus boycott started off as one day. And then it started, it continued on. So I have the feeling, maybe because I just have a lot of faith, you know what I mean? And plus I'm a woman, so I know Target. I know how much we spend in Target, or I would have spent in Target, even in one day, even in 1 month. Like I said, I quit Target back in January, removed them and all of that. So, if you really think about it, plus, I got a friend of a friend who told me one of the Targets closest to our mall here in Durham, Leon, is their sales was down negative. Their sales goal was negative 20% yesterday.
That's good.
I could understand that. Rene, you being a Black woman, the foundational piece of modern society. One thing I could also say is our fellow Black women understood the assignment, and I'll just leave it at that. And so, we all know what happened with Target. Target got orders from amongst high and decided to take the easy way out and say, you know what, we're going to do away with our, DEI, which has been made into a boogeyman, which has been made into a slur, which has been made into something scary that is not, but the way I see it now, we have the exact opposite. We have reverse DEI. We have didn't earn it, where we see a cadre of unqualified individuals in certain positions of power that I won't get in specifically, that are running roughshod. And so I think the content of a person's character and the content of a person's background is what should carry the day, not who you know, not who you grovel to, not whose boots you lick. So
100%. I would agree with that. Now, let's talk money.
Let's do it. What you got for me?
Well, first of all, give us a little bit of your background on how you got here, how long you've been in wealth management.
Yeah, so I have been in finance for 23 years now.
Really?
So I've been working predominantly in the wealth space and the affluent space for the last 10 plus years. I started back in, actually about 21 years. It all bleeds together when you're talking about decades. But I started as a 19-hour part-time teller at B of A in Berkeley, California, back in 2004. Didn't even get benefits at the time. And, over the last 20 plus years, I've been able to work my way up, through the ranks and getting certifications and getting securities licenses and getting experiences that have made me valuable and able to carve out a career for myself. I don't come from a traditional banking background. Most bankers in my role or in my area of expertise, they have finance degrees, they have MBAs, they come from fancy colleges. I was 19 years old when I saw two pink lines. I was a young dad. I have a few community college courses. I don't have a college degree, yet alone an advanced degree. But I'll put my intelligence, I'll put my experience up against anyone. I can talk markets with anyone. I can
hold on.
Command it.
Are you talking about now or then? You don't have those degrees then?
Don't have them now.
Okay.
I have my Series 6, 63, 7 investment licenses. I have my state
don't
license.
Don't put that out because that's hard to get. So let's not downplay that. That's the level of going to college. Your Series 6 and 7. So
let me tell you, and a lot of people don't pass that test the first time, which I did. I have a multitude of leadership certificates from McKinsey. Matter of fact, I just got chosen to represent my institution at UC Berkeley in their Black Executive Leadership class that's coming up in the fall. I literally got a call yesterday from the representative at UC Berkeley. And so, I'm always going to continue to try to further my education, but I try to use myself as an example. You don't have to come from a traditional background and have a traditional, experience level to be able to be successful, and so again, I take my intelligence, I take my experience, and I'll put that up against anybody. And I make my clients money, and I give my clients sound advice, and I give my community sound advice. And I'm looking forward to giving your audience today sound advice to the best of my abilities.
And does it well with the letters after his title. Look at that.
Now, what type of clients do you typically work with?
Yeah, so in the affluent wealth management space, if we want to be technical, I work with clients in the range between $250,000 and $3 million in net worth. So that could be in a combination of investments, so securities. That could be in connection with cash assets, so checking, savings, CDs, but also pertaining to credit. So that could be mortgage, that could be home equity, that could be personal loans and lines, that could be small business. And so, I have experience in all of those areas. So from a business perspective, from a wealth management perspective, from a banking and lending perspective. So I try to be that Swiss Army knife, jack of all trades that can talk about a multitude of things to a multitude of people and be valuable to my clients and to my community.
Love that. Now, you say you kind of, your clients range from 250,000 to 3 million. I'm sure throughout your career, you've worked with some clients on a smaller scale. Their budget
absolutely
is
and larger.
And larger, yes. So looking at some of our, I would say our people, our community, on a smaller scale, I would say, what's one thing that they should look at if they want to really, smaller investments? Maybe they don't have, thousands to put away. Maybe, maybe $50 to $100 there. What's one thing you would tell someone with a smaller budget, how they would be able to save, or what would be the best course of action?
So I got to expand on that a little bit because it's not just investing that's one of the biggest ways to drive wealth. It's also owning property. It's also ownership. And so what I would say first and foremost before even investing, I would recommend that people get your credit straight. Get your credit in line, right? Know what the 3 credit bureaus are: Experian, Equifax, and TransUnion. Know how to look up your credit report. Know how to repair or build your credit, because that's what's going to enable you ultimately to really build wealth. Because when you look at it, you can't buy a car without credit. You can't rent an apartment without credit, yet alone get a house loan. You can't get a job without them running your credit. And so first and foremost, you got to get that credit in order, because that's the system that we run on. Sometimes it can be unfair, but let's just keep it real. Credit is king in this economy, in this society. You got to have those 3 numbers on point, right? And so when we talk about, Rene, when you go further into your question about investments, right? For the beginning investor, or even for that investor that has a little bit of experience but is looking to have an easy and effective way to put together a portfolio, I would always recommend an index fund, either an index fund or an ETF, what's called an exchange traded fund. It's a fund that's traded on an exchange. So, New York Stock Exchange, NASDAQ, things like that. The reason why I would recommend investments like that is because they're what's called passively managed. They don't have active portfolio managers that are managing those index funds and ETFs. And so they have much lower cost. They're more cost efficient. So instead of paying a 1% or 1.25% management fee to an investment advisor to manage funds actively, you can look into purchase an ETF or a mutual fund or an index fund that just mirrors a certain index. So for example, the most popular index fund right now is the S&P, Standard & Poor. S&P 500 index fund, comprised of 500, or actually 525 to be exact, of the largest companies in the United States. And so it's a way to be diversified in a lot of different companies, in a lot of different asset classes, in a lot of different areas, without having to worry about paying a lot up front to have that managed. But it's a way for you to really get your foot in the door. And a lot of online brokerages, so for people that want to trade themselves and keep their costs low, if they're looking to get into the market and invest, a lot of the online brokerage houses, they allow you what's called proportional shares. So you can go and buy slices of stocks and buy a piece here, buy a piece there. Now that's when you're buying individual stocks. Now, unfortunately, when we're looking at index funds and those ETFs, you're going to have to buy full shares. But, also when I do give advice for people, especially younger people who do want to learn how to buy stocks and what stocks to pick, right? I always say, buy what you know. What do you see every day, right? What kind of shoes, what kind of shoes do you wear? Most people have a pair of Nikes. Go online, Google Nike stock price and buy some shares of Nike. Hopefully we all wash our clothes, right? And wash wash our behinds. Well, what type of soap do you use? What type of laundry detergent? What's the brand of your washing machine? Whirlpool. Guess what? There's a stock for that, right? So I would say buy what you know, because these are big, healthy companies with healthy bottom lines. Everybody knows them. Everybody buys them. So there's not a real threat of Nike going out of business. There's, what do we all, when we go to a restaurant, we go to McDonald's and buy a Big Mac value meal, right? What do we get? We're getting a Coke, we're getting a Sprite. So that's Coca-Cola Company, right? You can buy stock in that. So if you're looking for a beginning investor thinking about what stocks to buy what you see every day. And if you have some disposable income, you got some bonus money, you got a nice fat tax return, and you're looking to really put a little bit in the market, buy yourself into the S&P 500 index fund. Try to buy as many shares of that as you can, because if you look over the last 30 years, we've had, 2008, we had the financial crisis. We had the COVID recession in 2020. There's going to be downturns in the market. But if you look over the long term, you're going to see the market do like this. It trends upward. It always trends upward. And so for those, especially for young people, the best time to buy is now, because when you're talking about wealth, right, it's really two things. It's a very simple math equation. Compounding times time equals wealth. Interest and wealth compounds over time. The more time you have in front of you, the better, right? And so let that time work for you. Put in a little bit every month. Instead of buying that coffee, say, okay, you know what? Let me just, instead of buying coffee 5 days a week, let me buy it 4 days a week, and let me save up a little bit. And at the end of the month, I'm going to be able to buy a share of some stock.
Yeah.
You know what? This month, I'm not going to buy a pair of those shoes. Instead of buying a pair of Nikes, I'm going to buy myself 2 shares of Nike. And so it's really about changing the dynamic and changing the thought process. And it's not reinventing the wheel. Our people, we are not any less talented than any other demographic, than any other race. But what we do have is a deficit of experience and a deficit of exposure.
Mm-hmm.
A lot of our parents, a lot of our families haven't had the chance to teach us how to invest, how to save, how to build credit. When I turned 17, you know what my first lesson in credit was? My mom took a credit card out in my name to pay the bills to survive, right? That's how life is for a lot of our people. Is we're trying to survive. We're working 2 and 3 jobs. Sometimes it's just dad. A lot of time it's just mom trying to take care of the kids, trying to put food on the table. We don't have time to talk about investments. We're talking about saving. We're trying to just save our family from being out on the street.
Yep.
Because when you're living on a knife's edge, you're 1 paycheck away, right?
Mm-hmm.
So we just got to get that exposure. This is what estate planning is about. This is what saving is about. This is what credit does. This is how you invest. And next thing you know, the more people you talk to, it's a multiplier effect, because then that knowledge spreads out like a web, like a spider web. We got to make sure that our people have access to that knowledge and that experience so we can change that dynamic, because only us can save us. Right. One thing we know right now, the government sure as hell ain't going to save us. Right. You can't depend on other races to save us. Mm-hmm. Most of them want to do the opposite to save us.
Yes.
We have to be down for each other, but we also have to be accountable to ourselves. Mm. How can I make myself more knowledgeable with the limited time and the limited resources that I have? Everybody ain't going to get rich quick. Everybody's not going to get rich in a day, but you can build pebble by pebble, brick by brick over time, so you can have something for yourself and something for your family. Sorry for that long ramble, but I feel very strongly about this.
That's cool. You said something. I think you mentioned diversify, but what would you mentioned mutual funds and index funds and ETFs, which I have. But in my early beginnings of investing, when I heard the word diversify, do you know I went and bought 50 single stocks? That was before I knew. I was just getting into it. And eventually I sold down and put everything in mutual funds, ETFs. So when you say diversify, if people were to buy some single stocks, what's the amount that you would say to buy? Like, not the amount of stocks, but the amount of each company. How many companies should you have individual? Or is it really?
It's not necessarily the amount of companies. When you really, there's a lot of different ways to diversify. Mm-hmm. One, you can diversify in what's called the asset class. So you can diversify stocks. That's an asset class. But you could also diversify overall. So you can have some bonds in your portfolio. You can have real estate. So there's diversity of asset class. Mm-hmm. And then there's diversity within that asset class. So let's say, for example, let's just say, to keep things simple, you want to have a diversified stock portfolio, right? Well, there's, again, the S&P 500 are the 525 largest companies in the United States domestically, right? Uh-huh. There's different class of stocks. There's tech stocks, there's healthcare stocks, there's energy stocks, right? So what is that old saying? Don't always put your eggs in one basket. Uh-huh. So what you want to do when you're thinking about picking stocks or picking mutual funds or picking ETFs, you may want to be diversified in different sectors. And when you're talking about investing isn't just a now. Investing is, you're thinking 5 years from now. You're thinking 10 years from now. What's going to be the hot thing 5 years from now? Not just what's hot right now. And that's also part of being diversified. Diversification of ideas, diversification, of time. So that's how you want to think about that, because all of these things, you never want to have all of those eggs in one basket. So you want to have, what's hot right now, right? Tech, specifically AI.
AI.
So you want to have, what are the hottest AI companies? But the thing is, though, what powers the AI? Quantum computing, microchip processors. So you maybe want to find within that some, a couple of the top microchip processors. Microchip processors in those AI farms, they use a lot of energy. They use a lot of electricity. So how are we getting our energy currently, and how are we going to get our energy 5 years from now? So there's index funds and there's mutual funds that deal with alternative energy. So we're talking about geothermal, we're talking about wind, we're talking about solar. But you also have to be aware of current situations. We know who the president is right now, and we know who controls the United States government. And those individuals have a philosophy that we're going to drill more oil, we're going to get more gas. So again, investing is not about emotion and who you think you wanted to win the election. But if we're trying to talk about money, let's talk about money. We know that there's going to be a lot more oil and gas extracted in the next 4 years. So maybe you want to look at diversification of your stock portfolio, your investment portfolio, to have more traditional energy resources, not just oil companies, but who's behind the infrastructure of those oil companies? What pipelines provide the oil companies with these services? What are the restaurants that most of the oil people in the oil industry go to eat at? So it's like all of those things are connected. So that's how you can be strategic without knowing a lot of these different stocks, but just knowing the concept, knowing who buys what, and knowing what's going on. If you know what's going on around the country and around the world, you can connect that to a stock. You can connect that to an investment strategy without being an investment specialist. But you just have to have your eyes open and be aware and look around.
I think that's probably where I get stuck on is you said something smart, is think about what is powering that particular stock that you're looking at investing in, because you can look at, like you said, the biggest thing going is AI, right? We can jump on the bandwagon, but what's behind it? What's the driving force behind it? And I probably wouldn't have, when you talk about investing, you don't think about that. At least I don't. To me, I'm a very instant gratification type of person. Like, I want to see it now, like 10 minutes ago. But that's really something to think about, of what's the driving factor behind all of these companies, the solar power and all of those things. I didn't think about that. So that's
just like was that Stryker? There were hospital equipment or medical equipment. I learned about that. You can invest in that, the Stryker stock. Everything in the house, the hospitals use a lot of equipment. Stryker.
Exactly. Everything is going to have every big company, every big sector is going to have infrastructure behind it. What's the infrastructure behind that sizzle, right? Everybody knows the steak. It's sexy. It sizzles. It tastes good. It's juicy. Right. But what goes behind putting that steak on the table? What are the logistics behind that steak? Where do you get the cow? What slaughterhouse do you get the cow from? What shipping company do you use to ship the steak to the restaurants? What distributor, right? So that's how you got to think about it. What's the infrastructure behind that? Because all of those moving parts behind what you see, that's how you make money. That's where the opportunity is at.
Yeah. Now, along with that, diversifying, do you think people should have more than one brokerage account?
That's
at least
really
two?
More personal preference. Okay. Some people have had the same brokerage account for many years. Other people, other clients have multiple, brokerage account. They have accounts at Schwab. They have accounts at Fidelity. They have accounts at JP Morgan. They have accounts at Wells Fargo. It really just depends on personal preference.
Okay.
In my honest opinion, it doesn't make too much of a difference. Long as you find an investment advisor that you trust, that does right by you, that has ethics. Pretty much every institution has the same thing. Everybody can sling stocks and bonds and mutual funds and ETFs. Everybody's going to be right around 1 to 1.25 asset under management fee. Everybody's that they're all the same. So what you want to look for as a consumer when you're thinking about opening a brokerage or who to work with, you want to look for those differentiating factors. I know clients that would prefer to have an investment advisor that looks like them. You know what? There's nothing wrong with that. Or some people want to have an investment advisor that only works for a large firm. Perfectly reasonable. So, the investor has to think about what makes them most comfortable, what helps them think, sleep at night, to put themselves in the best situation.
Right.
That makes sense. Well, let's talk about like long term, and I would say the biggest thing that's on the table right now, retirement, right?
Yeah.
That's one of the major things, Social Security, savings, all of those things. Contributions, your income contributions, and do you think, before we get into retirement, because sorry, my brain is going because my friends, they're like, ask them this, ask them that. Your 401k contributions. Do you think, someone going in, they're starting a new job. I know with some jobs, they have particulars after a year, they'll match. Do you think it's healthy or good to match the same amount as your company is matching? Or do you think you should go over the amount, or, climb the 1%, I guess?
Okay. That's a great question. So let's start with the bare minimum. So number one, some jobs will start matching immediately. Mm-hmm. To your point, others will start matching in a year. A lot of people, and I think incorrectly, say, you know what, I'll start contributing after a year once my job matches. Don't do that. Start contributing immediately. Even if your job isn't matching right now, you get the ball rolling.
Mm-hmm. Right.
Most companies are going to contribute between, I'd say, 3 and 6%. Mm-hmm. That's pretty much the standard range, 3 to right around 6%. So first thing you want to do is find out what match percentage your job offers. And at the bare minimum, whether they're matching it immediately or not, start contributing that amount.
Mm-hmm. Get used to it being deducted out of your paycheck to see what it's like, right?
Exactly. Because if you don't, you're going to give away free money once they do start matching. If you don't put that minimum aside, you're losing free money. Mm-hmm. Because you're not even getting the minimum match that your job offers. So always try to make sure that you contribute at least whatever the minimum is that your job matches. Me personally, I have my 401k set to auto increase. It increases 1% every year. Mm-hmm. That's what I can afford. It's convenient for me, and it works. I say a person should do what's convenient and what works for them. Everybody may not be able to do that, and that's okay because we're all different. But definitely try to maximize that 401k contribution as much as you can. Always contribute to your 401k. Wherever you go, if you leave and go to another job, contribute to that 401k. And if you leave that job and go to another job, contribute to that 401k. Now, let's take a quick step back, because when you leave a job, you have two options, right? Mm-hmm. You can either roll your 401k over to your next job and put it into their 401k, mm-hmm. or you can roll over your 401k into what's called an IRA, Individual Retirement Account, IRA. Mm-hmm. Either one of those are going to offer tax benefits. They're going to offer what's called your taxes are going to be deferred, mm-hmm. Deferred taxes. So the retirement age right now is 59 and a half years old. If you take, I'm sorry.
Allegedly.
Yes, allegedly. Well played. So the alleged age technically is still 59 and a half. So if you take anything out before that, there's going to be a 10% early withdrawal penalty, and anything you're going to take out is going to be treated as taxable income, right? Anything after that, you just pay the tax man and you keep it moving. But, most people, when you're talking about building wealth, they're going to take those 401k funds and put it into an IRA, like a brokerage IRA. Mm-hmm. And there's one really specific reason why. When you compare a 401k plan to a brokerage account, you're going to have a lot more choices in a brokerage account. Mm-hmm. Most 401k plans, you got your target fund, and you got a few other funds. You got an international fund, a large cap, mid cap, small cap, and some bond funds. And that's it. Brokerage IRA, mutual funds, ETFs, stocks, bonds, treasuries, So you have a lot more choices. You can be a lot more diversified. We're going to go back to that word probably more than one time, Leon. So,
right.
you got the right word choice, my friend.
Right.
So, Rene, I know I went on a little bit of a tangent, so please redirect me. What was your original question?
No, I'm just saying, is it good for someone to start matching immediately? And should they, if their income allows them, should they match what their employer is matching?
Yes.
Because I hear some people are saying, my employer matches 5, but I can't afford it. And I'm like, get as close to it as possible.
Do 5.
Close to it as possible.
Yeah, because if you don't do what your employer matches, you're leaving money on the table, point blank. You're going to lose more money not getting your full match than you are saving it by trying to, keep a little bit more money in your pocket. Because remember, the money you keep in your pocket to pay bills or to do whatever, that's not compounding, that's not growing. That money's being spent. So remember, compounding times time equals wealth. Put that money in there. There's ways that we can cut, set it and forget it. Trust me, if you set that at 5%, you won't miss it. You won't even be thinking about it because it's automatic. You'll figure out a way to work it out more often than not. There's ways, but wealth doesn't come for free unless you get to pass down, and ain't nobody pass me down squat. So we got to do the hard work, because I'm of the mind that when I'm old, when I'm Social Security age, there ain't gonna be much Social Security left for me. There may not be enough Medicare for all of us.
Right.
And if you look at the current budget being proposed, there might not be any Medicaid for most people right now. Right. So you got to have a plan so you're not living destitute, or you're not being a Walmart greeter when you're 59 and a half. Right. So you got to try to be of the mind that I don't know, and I can't trust that Social Security is going to be there. I can't trust that Medicare is going to be there. So how am I going to build some wealth? How can I own some property? How can I have a portfolio working for me? How can I diversify my income and diversify my wealth and give myself more chances at generating wealth? Maybe it's not just working a 9 to 5. Maybe it's having something on the side. More people now than ever before, are doing other things. They're doing things online. They're doing things, with e-commerce. They're doing Uber and Lyft. They're doing things to hustle. It's not because it's sexy to be in the hustle economy. Unfortunately, it's a necessity for a lot of people. I mean, just look at our teachers. Our teachers routinely are working at Starbucks. They're driving Uber and Lyft at night, all the while still paying for school supplies. Like, do teachers deserve that? Do firefighters deserve that? Does anybody deserve that?
Right.
But you have to put yourself in a situation to try to supplement that income, and you got to use the tools that you have to try to build that wealth, so we can avoid those situations over time.
Right.
What about those who receive like a yearly bonus? What do you think is the best use for that? Because we know bonuses get taxed so much. What is it? 30?
About
is it 39.5 or what is it?
About 40%.
About 40%. Yeah.
Yeah, which I think is a travesty, that working people, rich people, just because we get bonuses doesn't mean that we're rich and we make a lot of money. That's just how, when you're working in finance in a lot of industries, that we get our bonuses paid. To get them taxed at 40% is almost criminal, because when you go to the robber baron class and the hedge fund class and the private equity class, they're paying like 13% carried interest. They're paying, 12%, 10% capital gains, to push around numbers and push around paper. But I digress. Right. That's a whole nother story. But I would just say, when you get those bonuses, first thing is to plan for it. What do I want to do with that bonus? Start to think about that before you get it, not just wait for when you get it. Okay, I'm going to put X amount towards bills maybe, or if you do own a home, I would say take some of that bonus money and pay that to the principal balance of your mortgage. Pay your mortgage off 5 years early. Pay your mortgage off 10 years early. The money you save in those interest costs, that's going to build you some wealth, and that's going to also build you equity faster. How do most people generate wealth in real estate? By purchasing other real estate. And how do people do that? They usually utilize equity. They're not just, always just getting new loans to buy another house. Some people are buying property that they've owned for a long time, and they take that equity out and they purchase other property. So there's ways to utilize what you have and strategically use it to build wealth.
Would you put it back into your 401k? I just happen to see this. I think you know where I'm going. I just happen
a lot of people do that. if you look into your 401k, there's that option. Do you want to, reinvest a portion of your bonus back into your 401k? That's definitely an option because you can get some bang for your buck. You can beef it up real quick and have that work for you. But you could also find ways, not necessarily with your 401k. You can take that and you can buy some stocks. You can buy some mutual funds. You can buy some ETFs. You can put it into a high yielding savings account to earn interest. That's going to be your new house fund. Okay, I'm going to take this. I'm going to take a part of this bonus and have it earn interest because 3 years from now, 5 years from now, I want to purchase a property. So, whatever you want to do, just do it with a plan. Do it strategically. Don't just do it off the cuff. Don't just start to spend it. Have a plan.
Yeah. Now you spoke about the IRA. Can you tell the difference between the IRA and the Roth IRA? And is it good to have both or just one? I noticed I talked to a lot of people in corporate that doesn't have a Roth IRA or IRA outside of work and 401k. Can you?
That's a great question. And so let's first of all, let's get into the definitions of both. So we have, to your point, Leon, we have what's called a traditional IRA and we have what's called a Roth IRA. And so really the biggest difference in those is how they're taxed and with time. So with the traditional IRA, that's what's called tax deferred. So you don't have to pay your taxes on that IRA right now. You're going to pay it when you start taking your money out after you're 59 and a half. So that's how that's taxed, right? Plus, you get tax advantages, like I said. So when you go and do your taxes at the beginning of every year, you're going to say, hey, I contributed $6,500 to my IRA. And so you get to write that off of your income. Now, with a Roth IRA, it's a little bit different. So, let me go back to traditional. So with a traditional IRA, there's also what's called an RMD, required minimum distribution. You have to start taking money out by the time that you're 70 and a half. Or it might have gone up to 72. I have to double check, but it's either 70 and a half or 72 years old. Otherwise, you're going to start getting penalized because, again, the government is like, hey, Leon, we've been letting you slide with paying these taxes. You've been growing this portfolio in this IRA tax deferred for 30 years. Hey, we need our cut now. It's time for you before you die, to start taking this money out so we can get our cut. And so they're going to make you do that. And so now with Roth IRA, it's different. It's the exact opposite. You pay the taxes up front. Hey, you know what? I don't want to wait. Let me just get this out of the way now. Here, Mr. Taxman, take my money now. And so instead of it being tax deferred growth, you pay the taxes up front. And then when you retire, you take those funds out tax-free. Also, being that the tax man also took his money from you already, there's no need for him to force you to start taking the money out. So there's not going to be any RMD, required minimum distribution, or any sort of age limit that you would have to worry about. Now, why would somebody do a traditional versus a Roth IRA? To answer your question, Leon, is Roth IRAs are typically used by people who are more in a higher income tax bracket. If you're more working class and middle income people use traditional IRAs. When you start getting into higher tax brackets and start getting into higher income levels, it's good to utilize a Roth IRA because what you're doing is you're banking on locking in and paying a tax right now, and you're banking on the fact that in the future, for 30 years from now, that you're more than likely going to be in a higher tax bracket. And so you'd rather have those taxes paid now than maybe when you're even more richer later. So it's a tool that higher income and higher net worth individuals utilize as a tax strategy and as a planning strategy.
Right. Okay. Anything on that?
I might need to look at the regular IRA, but I'll talk to you later about that. Now, Leon is a super fan of Dave Ramsey. He
I was gonna bring that up earlier when he said something. I was gonna bring that up earlier when he said something.
How do you feel about Dave Ramsey and his savings methods?
I want to hear from Leon first. Leon, tell me what you wanted to talk about. What'd you have on there?
You said something earlier. I can't remember what it was, but I like Dave Ramsey. He's funny to me. But I think he was talking about. He said credit is king. That's what you said. Credit is king. Dave Ramsey said cash is king. Cash is king. But I think he's just for some people. He's not for everybody. A lot of people don't like him because his style, his ways are old.
I think they're outdated.
I think a lot of people can't afford to do what he's saying do. But no, that's it. I like Dave Ramsey. I watch him. You can take some from him, take a little bit from him.
But, I think, I wouldn't say I'm a huge fan. I wouldn't say that I'm not a fan. I know of him. I'm aware of him. I think, he has value to a certain demographic, to a certain segment of people, and that's totally cool. I would just say take value from whatever resources you can. Cash is king when you have cash.
Mm-hmm.
That's if you have cash, sure, cash is king if you have it available to you. But for a good portion of the American population, we don't have that ability to have cash be king. So we have to, we credit is king for people, when you're looking to buy a house, because we're not buying the houses in cash right now. That's the investor class. That's the wealthy class. When we're buying a car, most of the time we're not buying a car with cash, we're buying a car on credit. And so, the dynamic is flipped. It's the opposite, but I would say it's good to have deployable cash. But I think cash isn't just cash. I like to call it liquidity. Mm-hmm. You always want to have access to liquidity. So if you have the ability to make a strategic move, you have a way to make that move. If an investment opportunity arises that you need to act quick, that liquidity you have access to. So whether that be with a line of credit, whether that's with just actual cash, whether that's be able to use leverage, whether that's being able to, if you're a business owner or if you have a pool of investors to be able to go out and get venture capital, whatever the case may be, having access to capital in whatever form that is, that's what's key.
Yeah, and I think he mainly targets, we do have a lot of people that get credit cards and just run them up and don't pay and keep getting more and don't pay, and they end up in a lot of debt and they can't get out. Yeah. I think, he's good for those type of people. That's what I think.
Yeah. And that's the thing, credit can be your best friend, but it could also be your worst enemy. Mm-hmm. Everything in moderation, whether that's credit or whether that's eating or whether that's drinking or anything else. Mm-hmm. Credit is a tool, but it shouldn't be used as a crutch. It shouldn't be used as a replacement for income, right? So we got to be very careful, but we also got to recognize that the things that we want in life in some way or another is going to come down to credit. So like anything in life, it's all about striking the right balance.
Right. And so you said something earlier about paying off your home. Some people think along the lines of, if you have a low interest rate, you shouldn't push so hard to pay off your home. You should invest the money. What you think about that?
I think an argument can be made for both approaches. Okay. I think, number one, right now, how many people are locked in a low interest rate right now? Right now, we're in a rising and a higher interest rate environment. So I think the time to be locked into a low rate, whoever got lucky and is locked in a low rate, good for them. That's great. Mm-hmm. But what is everybody else going to have to do? What strategies are they going to have to employ, for what the current situation is? Right. And so, for people that are in a low interest rate, there's definitely an argument to try to keep your cash flow, as high as possible. And, while you're, since you're locked to that low interest rate, to do other things. And I think that's okay, but I would say, why can't you do both? Why can't you take advantage of that low interest rate, but also still pay a little bit down? Because at the end of the day, would you rather have low rate debt or no low rate debt? The goal is still to be debt free. Mm-hmm. That's still the goal at the end of the day.
And you're saying with that additional money, you're accumulating more debt.
Yeah. And at the end of the day, paying your loan off early, if you can, and being debt free, that's also going to free you up to be able to do a lot more things. And now you're going to have a paid off house that you can utilize, or by the time you pay off a house, you're going to be close to retirement age. Possibly, maybe you want to make that part of your estate plan, or maybe you're like, hey, you know what, I did good. My kids are out of the house. I've helped them buy their first home. They all left the nest. Maybe I want to sell my house and downsize and have a nice little nest egg to boost my retirement up and live comfortably and go travel. So it, one, it always is going to depend on the individual once again, because some people see value in paying it off early. Some people may see value of keeping the low rate as long as possible, and both can be okay. I would say, once again, you do what's best for you. Have a conversation with a CPA. If you have one, have a conversation with your financial planner / financial advisor and let them run those numbers, because there's planning software out there that could actually run what's called Monte Carlo simulation. It's a form of statistical analysis, and they could actually model and game out those situations and show you on paper, hey, Leon, this is what it'll look like if you pay your house off early, and how that looks to your cash flow and how that looks to your overall wealth picture. Hey, Rene, this is what it looks like if you stay in this locked low interest rate and utilize your capital to use that equity and get a loan for another property, and what that would look like. So, talk to a financial professional, and they could usually utilize some very, very accurate and very sophisticated software and modeling, and actually show you what each of those scenarios look like. Because I always like to say is, it's never a bad thing to have as much information and as many options at your disposal to make the best, most informed decision. And that's really what I try to do in my role. Is I try to help clients and provide them with information and options so they can make the best, most informed decision. At the end of the day, if I do that, I've done my job.
I pay my mortgage based on an amortization schedule that I created, because I can do one myself just in the business that I'm in, which is money. So, and everyone is given that at the time of origination. Where you should be at. It tells you what month, and then you can look at where you should be. So if you want to jump up to year 2027, it's going to tell you what you should be paying for year 2027 and how much is, what's going to interest, what's going to principal. It gives you a full breakdown. It's all about what you can afford. But that's my tidbit for that.
I like it.
It is given to everyone at the time of origination. You can ask for one at any time through your bank, your servicer, whomever. I have another question for my one of my friends told me to ask. They are looking at doing some work on their home, right? Mm-hmm. They want to upgrade their kitchen. Is it better for them to, in your opinion, to take out a HELOC or pull from their 401k?
Absolutely, 100% you can do a HELOC. Do not pull from your 401k, because you first have to remember what rules for your 401k. Mm-hmm. To pull from your 401k, there's only a few allowable things that will actually even you receive permission to pull from your 401k. Mm-hmm. Financial hardship, mm-hmm. first time home buyer, mm-hmm. life change, mm-hmm. right? So there's only 3 or 4 things that will actually be able to allow you to pull from your 401k, mm-hmm. Or you can do, that's if you just want to do a withdrawal. Most people would borrow from their 401k. That's mm-hmm. probably, that may be what they're thinking, because they wouldn't be able to do a withdrawal.
Yeah.
I would not borrow from your 401k, because when you borrow from your 401k, the moment you do that, you are interrupting your clock of growth. Again, mm-hmm. going back to the original thing that we discussed, compounding times time equals wealth. Mm-hmm. When you're taking from that 401k, you're borrowing from that 401k, you're taking a big chunk out of that is no longer going to be actively working for you. So mm-hmm. even if you think you're taking out that chunk of your 401k and you're going to pay it back in 5 years and you're paying it back every month, you're really not. You're really sacrificing 10, 15 years of growth, because you're taking away all of that compounding, mm-hmm. right? It's much more effective and it's much more efficient to utilize a home equity line of credit and do those home improvements with the HELOC. Now, I would always say consult your tax advisor, but typically when you do a qualified major home improvement, part of those improvements can be written off and have a deduction on your taxes. And so again, consult your tax professional to confirm that. But typically in many cases, when you do a major home improvement from a home equity line, you can write off the interest. So not only are you going to get potential tax advantages, but I just think you're going to be saving money and generating money, instead of taking that from your 401k, utilize the HELOC, utilize credit, again, liquidity, leverage, capital. That's what it's there for. Your 401k is specifically for retirement, specifically for after you're 59 and a half, so you can have something that you're not destitute and greeting people at Walmart. Don't mess with that. That should be the very, very last option.
I like that. I hope they're listening. If not, I will relay the message.
By the way, this is absolutely no disrespect to any Walmart greeter out there.
No disrespect.
Someone may be retired and just want something to do.
We know.
Exactly.
We know.
Nothing but love.
Yeah.
Nothing but love. Now, what about life insurance? I know we had a discussion about that, and you were given a lot of questions in one of our forums that we're both in a group of. And we talked about, I believe it was a discussion based on what's the best life insurance policy. Is it term, or is it, what is it?
Whole life, term. What's, I know it's based on, health and all of those things, but what do you think right now would be the best policy for?
Great question.
For the average person.
The average person with no.
For the average working class person.
The average working class person.
Gotcha.
I'm gonna throw out a number of how much the average person would make. What's the average? Maybe is this? I don't want to. No shade to none of our viewers. I'm just throwing out a number. I'm gonna say
$56,000 or something like that.
Yeah.
Yeah, right around $56,000, I think, is the median average of the United States worker.
Yeah.
So let's take a step back when we talk about insurance. And I want to stress that having life insurance is an effective part of any successful estate plan, right? So if you're talking about estate planning, you're talking about a will, you're talking about a living trust, you're talking about a power of attorney, and you're talking about advanced healthcare directives. Those are really the four pillars of a successful estate plan, right? So life insurance is a big part of that, because one, life insurance can use to pay for final expenses. Life insurance can be used to pay off debts upon your passing, so your family's not saddled with that debt. You want to pass on wealth to your family. You don't want to pass on debt, right? Life insurance, in the last 15 to 20 years, though, life insurance also now can be used as a wealth generator. There are insurance policies out now that can have you invest just as good as any stock portfolio in the land. But circling back to your question initially, is for the average working person, the most popular and the most cost-effective type of life insurance is term. Term life insurance is cheap. Term life insurance is easier to get approved for. And, again, most people get term life insurance who are in the lower to middle income brackets. Now, if you have the wherewithal, I would recommend doing whole or universal life, because with whole life, you can build cash value that you can borrow against, that you can do withdrawals from. So you have a lot more flexibility. The premiums are higher. It's harder to get approved because they have more. They may have more stringent application standards, but you definitely get the bang for your buck. And with universal life is the, if you want to, if term life is your Honda Accord, if whole life is your Lexus, universal life is your Maserati. It's the platinum level of life insurance, where you can have separate accounts where you can invest in stocks, bonds, mutual funds. There's a whole litany of different riders, from lifetime income to, joint survivorship, all sorts of stuff. I would say when thinking about insurance, always talk to a professional. Talk to your financial advisor, talk to your CPA, talk to someone in a professional capacity, and they could actually help guide you on the best insurance policy that works within your budget, that works best for your family, that works best for you. I would just make sure to say to the audience is, I highly recommend that you have some sort of life insurance. And I also would recommend to your viewers that you have an estate plan. Please get a will. Please establish a living trust. Please get advanced healthcare directives, because heaven forbid, if something ever to happen to us and we can't think for ourselves and we can't act for ourselves, have something on paper so our loved ones don't have to have the burden of having to decide or having to guess what we would want done for us if that were to happen. So and have your financial power of attorney. Because once again, if you're incapable of thinking for yourself, or if you're incapacitated, you want to have someone you can trust to manage your financial affairs, so you don't lose your house, so your bank accounts aren't drained by someone shady. It's hard. Nobody wants to think about death. Nobody wants to think about if we lose our marbles. Nobody wants to think about if we get sick. But in one way or the other, one of those things are going to happen to us all. We're all going to die. It's just a matter of when and how and what happens in between. So it's always best to be prepared. I hate to sound morbid and kind of blasé about it, but that's the God's honest truth. That's a fact of life. And so being prepared in that way is going to be very helpful, and it'll save your family a lot of heartache in the long run. 100%. Because nobody wants probate.
Yeah. Nope. I seen one thing that I saw that someone said that you can, as far as when it comes to your bank accounts and things like that, I'm pretty sure they'll be all tied into your will and all that. But they say also you can go into the bank and, what's the word? What they use? Deliver upon death, as far as the bank account. It was something like that.
POD, payable on death.
Payable, yeah, upon death.
That's a fancy way of saying adding a beneficiary.
Right. Yeah, exactly.
Yeah, you're adding a beneficiary. So upon your passing, your beneficiary, whoever you have named as a POD, payable on death, they will come in with their ID and they'll provide a certified copy of your death certificate, and they'll be able to access those funds. That's also a form of estate planning.
Right. Yeah.
It's one of the most basic forms of estate planning, but it definitely, when it comes to financial affairs, it gets the job done.
It does. Definitely a trust. Please. Yeah. A trust.
So give the audience some
irrevocable trust.
Irrevocable trust.
Lay it off. Wills can be a little bit tricky if your daddy got kids you ain't never, or your mom got kids you ain't never seen before. It can be very, very sticky situation.
Small correction, Rene. That's going to be you would want that to be a revocable trust. Typically, with irrevocable trust, that's usually after someone has passed away, and so that's someone when those assets switch to the estate. But I get where you're coming from, though.
Yeah, because
give the people some different brokerage accounts to use for the ones who don't know different brokerage accounts.
So again, you always want to go with somebody that you trust. You want to go with somebody well known. And so most of the brokerage houses that offer either self-managed online or active management or a combination thereof, your big brokerage houses are going to be your Fidelity, Charles Schwab, E-Trade. I don't really particularly recommend Robinhood. There's been issues with Robinhood. When we talk about other financial institutions that do investments, you have your JP Morgan, biggest bank in the basically biggest bank in the world, but they have a very good wealth management division. Your Wells Fargo, you want to go with your before they collapse, I would say First Republic, one of my old institutions, but they had the unfortunate thing to collapse and fail. So, sometimes that happens. But you want to make sure that the institution that you look to have your investment with are large, that are relatively safe. You always want to look at the fee structure. Are the fees reasonable? But like I said earlier, everybody has a brokerage house. Everybody offers stocks and bonds. Everybody can sling investments. So you just want to just look for those differentiating factors for you to make that decision.
Yeah, so I got my start by one of my clients, Larry Thomas. He got me started investing some years ago. Then I have another guy. I don't know if you want me to say his name, so I won't say his name. But so for people that I talk to, I'm a barber. I don't know if Rene told you that. I cut hair, and come across a lot of people who don't know anything about stocks, investing, or anything like that. And as I learn more, I try to help other people learn more. So what I usually do is I direct them to Stash to kind of learn. You can buy fractional shares and things like that. What do you think about stash?
This is where you'll have to educate me. Tell me a little bit more about stash.
It's like a platform, an app that you can. I mean, it teaches you everything on there. It just has individual stocks. It has ETFs. It has all on there, and you can just invest. It's like a brokerage account, but I direct people there just so they can learn how to do and what to do, and I show them the ropes on there. And one time I helped somebody open up a brokerage account on Vanguard, and help them set up something for their kids and stuff like that. But I just try to.
That's amazing. That's definitely how you pay it forward.
Yeah.
I urge you to keep doing that, and I hope somebody that you've helped will one day pay it forward to help somebody else as well. And again, that's what we need. We need that multiplier effect. We need to help each other. Mm-hmm. I'll have to do some more research on stash, but from what you tell me, it's a good, it's been an app that you recommend to people. I'm a big fan of having the option to be able to buy proportional shares, because I think that is a way for the working class investor to start to build a portfolio without having to buy a full share. Right. So I'm a big fan of that. I can't make a recommendation for stash, because I'm not familiar with it. Mm-hmm. So I would just say, do your research. And that's sometimes in my line of work, we only have access and we are only licensed and we only, per compliance, can only deal with a certain subset of brokerage houses and investment accounts, So if there's other options out there, I definitely would advise your audience to explore them and do their due diligence.
Right.
That's some good advice right there. He's talked me into stash, but on a different scale as far as, where I'm at, I may have to seek you out again, Kylan, via
happy. Hey, there's no escape now. You know where to find me.
I know. Mm-hmm. And you in the group. So if you don't answer my team's message when we have our group again, I believe it's March.
Yeah, it's March now. I'm
gonna
have to change my identity if I don't want to be found.
I'll catch you in the group.
I go underground.
And what's the difference between growth investing and value investing?
Well, really what the name implies. So, growth investing is really going to be focused more on growth. Mm-hmm. Now, everything is going to come at a cost. If you're going to have a portfolio or an investment philosophy is going to be more growth oriented, consequently, you're also going to be taking on higher risk. No risk, no reward. Higher returns typically indicates higher risk as well. And so growth portfolios, you're going to be looking into a lot of growth stocks, or what's called small cap. These are smaller companies with big upside, but they also, being smaller companies, tech, startups, they're also at higher risk of failing, of going out of business. But when you hit on those, you could have the next Amazon, you could have the next Google, you could have the next Tesla, before Elon went crazy, of course. That's so when you're growth oriented, you take on that risk, but you're going to have higher reward. Typically, a growth portfolio is going to be for someone who's younger, who has a longer runway before retirement, who will be able to, through the benefit of time, can ride up those ups and downs, that comes with a riskier portfolio and with a riskier investment focus. When we talk about value stocks and a value portfolio is really looking for those type of stocks that you seem as underweighted, undervalued. This stock is trading at $50 a share, but most analysts think it's $60 a share. It's undervalued. Maybe they had a bad quarterly earnings report and that got their share price down, but their fundamentals have been super strong over the last 5 years. So that's going to be a value stock. You're looking for, you're a target shopper. You're looking for value. You're looking for a deal. So that type of philosophy is where you're looking for, typically a chance for higher returns, not super big growth, but you're also looking for low expenses. So most value in a portfolio, you're going to have a lot of ETFs, right? You're going to have a lot of value stocks that are, probably that are less than $100, so that, that are going to be, undervalued for whatever reason. And that's where but value stocks are having to do a lot more research. You have to do a lot more research because you have to find out why those stocks are a value stock at that particular time. And, you got to try to give yourself a good idea when that stock is going to rebound. Again, you have to figure out what's the factor that's making it a value stock right now. Is it a factor that's going to worry me, or is it just a natural factor that's that's going to come back up soon enough? This quarterly earnings report that was bad was because they just sunk a couple $1 billion in R&D or into something that that's going to make their bottom line look bad, but it was strategic. So just be mindful of the reasons why a stock is maybe undervalued before you jump on it. Every deal isn't a good deal. Everything that's on sale isn't actually a good sale.
All right.
Sometimes things are on sale for a reason.
And I don't have too many more. I got one more question. I don't know if Rene have any, but what do you? I know some people that I do introduce to stocks. As soon as they make a little money on a certain stock, they want to take it out. I'm like, I'll be like, is this really going to help you? Do you really need this? What is your advice on just taking money out?
Don't. So there's a lot of people out there. There are investors that are day traders, but that's what they actually do for a living. They buy and sell every day, every hour, every minute. That's what they do to make money. So it's on purpose. It's strategic. But for most working people, typically when you start investing, it's for the long term. Don't try to be a stock picker. Don't try to time the market. Just keep investing and, buy and hold. Don't be tempted when you see the stock go up 20% and you want to sell out and make a quick profit. One, by the way, you'll be taxed at a higher percentage because if you don't keep a stock for over 1 year, it's going to be what's called a short-term capital gain, which means it's taxed at regular income. So whatever your highest income level is in your tax bracket, you're going to be paying that full tax bracket. Long-term capital gains is any capital gain over 1 year, and the capital gain and the long-term capital gains rate is typically significantly lower, rate that people pay. So it's tax advantageous to hold a stock long-term, but I think it's also advantageous long-term for an investment strategy to look for that long-term growth. Imagine if somebody invested in Amazon in 1999 or in 2001 and then sold 2 years later when Amazon was up 25%. Imagine what they would have missed out on. Or, so it's like, don't take the quick buck. Don't take the quick buck.
Unless you really need to. But hold it for the long haul.
That's what investing is about.
I have another question. They're coming through my phone.
Okay.
Is it good for someone to max out their this is going back to work and benefits and everything? Is it good to max out if you have an HSA or FSA? Is it
HSA?
Mm-hmm. What's the other one?
FSA, flexible spending account.
Yeah.
Well, it's definitely a good thing to max out your 401k. Let's start there. If you have the ability to max out your 401k, max out your 401k anytime you have the chance. Really, when it comes to maximizing either your FSA or your HSA, it really depends on your situation. Because if your healthcare costs are typically low, why do you want to max out the deduction on the HSA if you're not going to be using all of those funds on healthcare expenses? So typically what you want to do is, know what your baseline is for healthcare expenses, and then give yourself a little bit of a buffer, in case you have higher expenses 1 year, and you'll be all right. But I wouldn't simply say like put the maximum into your HSA, unless you have like a high deductible plan. But I would also say in that case, talk to your CPA or talk to your tax advisor or talk to your financial advisor as well, because again, you can game that out and see what are the advantages of maxing out that HSA versus not. But don't just do it for any reason just to say that I'm maxing that out. If you're going to max out anything, max out your 401k contributions, not your HSA or your FSA.
Okay.
Great question.
I thought I had that was my last question, but how many different IRAs are there? I know that there's a SEP also.
So SEPs are only for entrepreneurs, for business owners.
Mm-hmm.
So they, because you have much more risk as a small business owner, they're subject to higher contribution limits because they're paying for their own retirement. Their contributions are for themselves, and so they have much higher contribution limits. So there's three. There's traditional IRAs, there's Roth IRAs, and there's SEP IRAs.
Oh, they're only three. Okay.
Right. Yeah, and there's, I don't know if it's still offered, but I think for a while there was something called a My IRA that was offered to the federal government as a way to have people have access to IRAs that if they couldn't go through traditional means with like a banker or a brokerage house. But have to look into that. But really, just traditional Roth and SEP.
Okay.
And SEP is for business owners.
Do you know anything about the backdoor Roth?
So there's a backdoor Roth and there's what's called a mega backdoor Roth IRA. Those are dependent on your job. Some jobs. So what you want to do when you take on a new job, you want to ask your HR provider if they offer what's called a backdoor or a mega backdoor IRA contribution. It's basically a way to be able to do additional contributions and have some tax advantages. So the reason why it's so secretive and so scarce and not everybody does it, because the government's not going to want people to be able to have different ways to invest more money and contribute more without, but that's basically backdoor and mega backdoor are ways to be able to make additional contributions in ways that give tax efficiency.
Now, is that after a certain age? So like if you reach a certain age that you can do that?
Depending on the job, there's different. Each job is going to have different factors that determines, the eligibility for the backdoor or the mega backdoor. Okay. Two things I would recommend you do is for your audience to do is one, ask your HR if their employer offers either backdoor or mega backdoor, and then number two, I would just recommend a quick Google search and just do a little bit of more research on it, and I think that'll give you more background on that. So when you have those type of different strategies, knowledge is power, knowing those full definitions, knowing how they work, and again, making sure to ask your HR provider at your job if they even offer that. That's the first question you ask, because they're not going to tell you that they offer it. They'll never tell you. You have to ask.
Must be something to it.
I wonder what.
Yeah, I learned that from I heard the money guys talk about that a lot. I never looked it up because there's nothing.
There's many tricks of the trade that are out there that most of the time people like us don't get a chance to take advantage of or get known about. So just again, going back to the beginning of our discussion, it's all about exposure. It's all about having that opportunity to have that information because, as cliche as it may sound, knowledge truly is power.
Right. And then activating that knowledge.
Mm-hmm.
Yep.
Even more power.
That's right.
Spreading it around. Equity.
Yeah.
Equity.
Shh, don't say that word out loud. It's taboo.
Well, you have any more questions, Rene?
Nope. I was looking through my phone. I don't have any more questions. I think this was very good. I'm so happy that you decided to join us today. Take time out. You're a very busy man. I see it. On a lighter note, how was All-Star Weekend?
All-Star Weekend was great. There were a lot of great events that were happening in the Bay. My institution that we both work at had some very, very dynamic events, some very dynamic speakers at some very dynamic places. So it was really cool.
Nice. I'm jealous.
So give me a takeaway. Give the listeners a takeaway. What say top 5 or top 3 things to do, or what's best for them to do when it comes to investing in life insurance or anything, whatever you want to give them.
Yeah. Number one, get your credit in order.
Mm-hmm.
Number two, just start. Don't think about a big number. Don't think about any number. Think about what you can. What do you have the ability to do today? You know, make it small.
Mm-hmm.
Everything adds up. You know, the most important thing is to just start and recognize that you need to start. And number three, I would just say, seek out information and ask. Ask a professional. Ask a friend that may have more experience than you. Ask a family member, but ask. Seek out that information, and don't be ashamed of what you don't know, and don't be ashamed of what you haven't done. It's never too late to start. It's never too late to succeed.
And get mad and try to learn more, because that's what I did. I got mad, and the more I learn, the more mad I get. Because
the information is out there. It's at our fingertips. Yeah. We just got to go out and do it.
Yeah.
You know.
Yeah.
Yeah.
I love that. I love that.
All right. Well, there you have it for another episode of the Impel Forward podcast. And remember, seize the opportunity to grasp your dreams.